Well, let's start out by taking a quick look at what's going on in the S&P 500. So this is a good representation of what's going on with equities. We're having a pretty sharp correction today. It's triggered by a couple of things, but from a technical perspective, I'm interested in this because we're at a potential transition point. The top of the market, we had a big shooting star up here. If you could, it's pretty darn close to one anyway, where the market was bid up way up on the 19th, came all the way back down. So we've got a shoulder head, potential shoulder here. Break of this neckline would be a fairly significant reversals signal. We might even anticipate prices down around 1,300 if we get a break of this level here. Now, we don't have it yet, but what's causing this? Well, it's a bit of a shift and an adjustment in the credit situation. So it's return of the credit crisis monster. The big news today, of course, is Wachovia Bank, after falling 30% in May, and then we can scroll way back here to get a perspective of how far they've already fallen over the last year. Well, following that, they came out and their write-downs were a little bit beyond what traders were expecting. So, which is kind of funny to say that in and of itself was not necessarily that unexpected. And then, of course, the correction today of about another 3.5% so far. So not only did they say that write-downs are more, but the board forced out management. And so we're looking at a lot of uncertainty here on Wachovia. That shook up the stocks, certainly. And we add to that the problem that S&P, who I'm sure is quite anxious right now to not be overrating anybody's debt, reduced ratings on Merrill, Morgan, Lehman, big banks, and all of which are taking a bit of a hit today, and that's compounding this problem on the stock market. Now, we're not seeing declines of 40 points in a day here on the S&P 500, but we are seeing a fairly sharp decline as traders are doing one thing. So today, they're shifting from higher risk, potentially higher yield assets to safer assets. So this is a day-to-day capital shift. It's not, one day does not make a trend, but it is definitely something that we need to keep in mind. Because what I find, I get a lot of questions as to why this would impact the forex. So let's talk about that. There's really two currencies that I'm watching most closely to respond to this adjustment, one of which is the dollar yen. And I've drawn a couple of lines here just to illustrate a few points. So the dollar yen and the dollar franc, both of whom are going to really respond to this move in equities. And they'll respond similarly, but for different reasons. So first, we look at the dollar yen, and the yen is going to strengthen here because of a short squeeze. What happens is it doesn't actually make the yen itself more attractive. It makes a short position on the yen less attractive. And what I mean by that is that anything crossed with the yen, here with the yen on the quote side, that's, if you're long, that's a short yen position, long dollar position. So if you're long the US dollar, Japanese yen pair, that's what you are. You're short the yen, you're long the dollar. Now, what happens is that traders begin to shift out of those short yen positions, which are very inflated right now. There's a lot of them out there. And it creates this little feedback cycle where a lot of stops get tripped, etc. And we start to approach the bottom side of a couple of different support levels. One is this Fibonacci level I've drawn from the bottom in March to the top in May. And we're beginning to close in on that first retracement level where we would suspect, from a technical perspective, we'd start forecasting support here at 23.6, which is not unreasonable. It's actually bisects the bottom of the support level here. It's been in place since April and May. And it's getting real close to the bottom of this little channel that's beginning to, this little upward trending channel. So worrisome, certainly. Annoying, yeah, for sure. But it's always a matter of how far do you let it go before you start to get worried? Because the market is going to be somewhat random in the short term anyway. What we're waiting for is to look to see if we get a break below the 23.6 or the lower level of this, or the lower band of this channel that we've been experiencing. So that's the first one to watch. We get a break there, then it might start to be an opportunity to take some action. Maybe to short the pair, probably more likely just to hedge against some of that risk, maybe a long put position on the dollar yen itself to offset risk that may be that may start to get a little bit out of hand at that point. We might even see 100 levels at that point. So the dollar franc is also going to be affected similarly, but for different reasons. This shift from higher risk assets to lower risk assets, the Swiss franc is a traditional hedge against risk. So you'll see the franc will actually become more attractive on a fundamental basis when risk and the credit crisis, et cetera, starts to get out of control. And we're approaching a couple of fairly significant or auspicious support levels as well. The first one is here at the 38.2% retracement level. It's already broken the 23.6 where it paused on Friday. And at the same time, that actually bisects support that occurred here in late May. So we've got a lot of indecision in late May. Market's approaching that level right now. That's at about 103. So if we see another drop, right now we're about 40, 50 pips away from that level. If we see another drop below that level, that's when we start to take some action because we start to approach this support level at the top of the consolidation that went from mid-March through April. Which is equal to the 50% level right here. So it's a matter of timing. When do we start to intervene? And it's also an opportunity for me to kind of throw in a pitch there. Longer-term investors have a little bit more flexibility because we've been in the position longer. There's a little bit more fat. So you can avoid some of these day-to-day periods of volatility. Will the market continue this trend that has started today? Well, we don't know. I don't know anybody who knows with any kind of certainty. What we really need to do is to wait for a little bit more evidence and then start to take some action, whether that means that we apply a little heavier hedges by buying a put contract that may offset some of that risk, or whether we start to unwind those positions as we get below some of those key benchmarks. It gives you a little bit more fat to weather the storm. So as the market begins to shake itself out and we can see what happens through the rest of the week, we've got some big announcements coming up. And then, of course, oil itself and stocks are both big wild cards this week. So we'll want to watch this information, but at least now we have a basis to see, well, what's the chain of events from the stock market into the forex so we know how to be prepared a little bit more effectively.